Today we're doing something a bit different, almost like time traveling, really.
Oh, yeah. Where are we headed?
Back to the early 1930s, right after the big crash. We're cracking open a real classic. Humphrey B. Neill's Tape Reading and Market Tactics came out in 1931.
Ah, Neill. A fascinating figure and, well, a really potent book, especially given the timing.
Exactly. And this isn't just some dusty old history lesson. We think the tactical stuff, the psychology, it's all surprisingly relevant today, wouldn't you say? Whether you're into stocks, options, maybe even crypto.
Oh, absolutely. It's one of those
Uh,
books that cuts through the noise.
yeah.
And, dedication alone tells you so much.
Remind us of that.
He dedicated, and this is really something, to my losses, with
Yeah.
a deep appreciation for the experience and knowledge which each loss has brought me.
Wow. Yeah, that hits differently, doesn't it? That's real market wisdom right there.
It is. It screams humility. You immediately know this guy isn't selling snake oil. He learned the hard way. This comes from experience, from actual skin in the game.
Totally. And he lays out this path, right? A structure for trying to find consistent success. 3 steps.
That's right. 3 distinct steps. And he's really clear you kind of have to master all 3. Skipping one makes the others, well, pretty much useless.
Okay, so let's break those down. What's the first pillar?
First, Neill says you absolutely have to understand the power and, crucially, the methods of the big professional groups. The insiders, the folks behind the tickers, as he puts it.
Gotcha. Know your enemy, basically, or at least know the big players on the field.
Precisely. If you don't understand their game plan, how they operate, you're just playing defense without knowing the offense.
Okay, so step 1 is understanding the pros. Step 2 must be about seeing what they're doing.
Exactly. That's learning to interpret the market's actions, theirs, the public's, everyone's primarily through the ticker tape, or, the modern equivalent, our data feeds.
So reading the tape is like learning the language of the market. Supply and demand in action.
That's a great way to put it. It's the unbiased record.
And the third step, the one he apparently found the toughest.
Ah, yeah. The big one. Mastering yourself, your own temperament, your emotions, greed, fear, pride, impatience, all those things that wreck perfectly good strategies.
The human element, the constant struggle inside our own heads when money's involved.
It really is. Neill makes the point that you could be the best tape reader in the world, technically brilliant, but if you can't control that urge to chase the last tick or panic sell in a dip, you're doomed.
Okay, so that's our map for this deep dive. We're going to follow Neill's 3 steps. First, the players, who's really driving things, their tactics. Then the language reading the tape, volume interpretation. And finally, the big one, the psychology, the self-mastery piece he calls market philosophy.
Sounds like a plan. It's a fascinating journey through his thinking.
All right, let's jump into part 1, the battlefield and the players. First off, I love how Neill just cuts through the mystique. The stock market, it's just a marketplace. Simple as that.
Yeah, it's almost brutally simple, isn't it? A place to swap stock certificates for cash. And the key idea he hammers home. Stocks are just merchandise.
Like coats or shoes or anything else you'd buy or sell?
Exactly like that. He compares it to the garment trade. The stock is manufactured, think underwriting, and then it's distributed for profit.
So when you buy, you're the customer getting the goods. When you sell, you're the supplier.
It's a powerful mental shift. It takes the emotion out of investing in a company you love and forces you to think about it purely as a trade good. Is it in demand, or is it going out of style?
And to understand who's trading this merchandise, he breaks down the market participants, 3 main groups.
Right, roughly 3 divisions. Group 1, the true investors. These are your big institutions, trusts, banks. They're in it for the long haul, mostly looking for income, dividends, slow money.
Okay, the bedrock investors. Then group 2.
Group 2 is basically the public. Business folks speculating, amateurs, people chasing tips, hoping for a quick buck. The less experienced crowd, often driven by headlines and emotion.
And group 3. This is where Neill really focuses his attention, right? The pros.
Absolutely. The professional operators, the floor traders, the investment bankers, and crucially for his time, the pools. These are the people actively making things happen.
And here's the insight that must have been mind-blowing in 1931. Group 1, the investors. They just don't trade enough to create the daily churn.
Not even close. Neill points out that the sheer volume of daily trading has to come from speculation. Groups 2 and 3 are the engine.
So speculation isn't just some sideshow. It's what keeps the market liquid and moving.
It's essential, according to Neill. He says the speculators carry the ball, keeping stocks active, afloat, until they eventually land in the hands of those long-term Group 1 investors. Without that speculative turn, the market would just, well, seize up.
Okay, so if speculation drives the market, then it becomes this constant battle.
A high-stakes battle, yeah, between Group 3, the pros, and Group 2, the public.
And the pros are trying to engineer things, scientifically even, so the public buys their stock at higher prices.
That's the core idea. It sounds cynical, but from a speculator's viewpoint, it's realistic. The professional sees the public not as a partner, but as a customer.
A customer who's buying enthusiasm or selling panic is the raw material for the professional's profit.
Precisely. The whole financial machine, from the big underwriters down to the traders, is ultimately geared towards distributing stock to the public, or profiting from the public's predictable reactions.
Now, we have to bridge the gap. Neill talks a lot about pools, these groups conspiring to rig prices. Those were largely outlawed, right?
They were, yeah. The Securities and Exchange Act in the mid-30s really cracked down on that kind of overt manipulation.
Sure.
So does that make Neill's book obsolete?
That's the question. Is it just a history lesson about illegal tactics?
Not at all. And Neill himself addressed this in later editions. He basically told readers, look, just mentally swap the word pools for pros or operator for pool manager.
So the players change, maybe the specific methods are more regulated, but the underlying tactics and goals persist.
Exactly. The essence of accumulation and distribution. The psychology they exploit, that hasn't changed. The entity doing it just evolved.
So who are the modern pros taking the place of those old pools? Who wields that kind of power now?
Well, think about the scale today. The modern equivalent is the enormous collective power of professional fund managers. Hedge funds, mutual funds, pension funds, institutional desks.
They operate under rules, sure, but the sheer amount of capital they control.
It's immense. Their block trades alone can move markets. Neill saw this coming even back in '69, noting institutions were already doing over half the NYSE volume. Today, it's even more concentrated. They have far more influence than those old, frilly, clumsy pools ever dreamed of.
So how do these modern giants accumulate stock without, obviously colluding like the old pools? They can't just paint the tape anymore.
Right, the methods are subtler. They use scale and patience. Huge institutions might use algorithms to break up massive orders, trade in dark pools off the main exchanges, or employ complex derivative strategies to build a position without tipping their hand too obviously.
But the psychological game, that's still the same.
Oh, absolutely. If a massive fund needs to buy, say, 1 million shares of something, they aren't going to chase the price up on a strong day. They'll wait. They'll use market dips, negative news cycles, maybe even seemingly routine selling pressure that they subtly apply by hitting bids.
To encourage the retail crowd, the public, to sell out cheap.
Exactly. They absorb that selling, accumulating their merchandise when sentiment is low, just like Neill described the pools doing. It's just done with more sophisticated tools now.
This makes Neill's breakdown of a typical operation even more relevant. Let's use his example, the Amalgamated Motor Car Company campaign. It starts with accumulation, what he calls the lie.
The lie is basically manufactured pessimism. Insiders get wind of some good news down the road, a big contract, maybe a stock split or dividend boost is planned. They bring in a professional operator, a manager.
And the manager's first job isn't to buy, it's to depress the price.
Or at least to facilitate buying at low prices. They might let negative rumors circulate, maybe even publish some poor-looking stats, or subtly sell short themselves to shake the tree and create pessimism.
They actively want the public to get scared and sell.
That's the goal of the accumulation phase. Bring out stock from weak hands who panic easily. The pro gathers their inventory quietly, patiently, often over weeks or months, waiting for the selling volume to dry up.
Okay, they've got their shares cheap. Then comes phase 2, the markup, the advertising campaign.
Now the manager flips the switch, the narrative changes. Suddenly it's encouraging rumors, positive leaks, optimistic statements from unnamed sources, maybe financial reports that are spun to look great.
But Neill says the real advertising isn't the news.
No, the most powerful sales pitch in the world, he says, is printed right there on the tape. Rising prices.
Because the pro is now actively buying, supporting the stock, absorbing, selling, nudging it higher.
Yes, they're creating the trend. And here's a really clever tactic Neill points out. Sometimes the pro will deliberately engineer small dips, little setbacks during the rise.
Why would they do that? Create selling pressure against themselves.
To lure in the short sellers.
Because anyone who sells short
becomes a guaranteed future buyer. They have to buy back the stock eventually to cover their short. So by engineering these little dips and inviting shorts, the pro is essentially building up future demand, It helps fuel the rally later on, especially during the final push. It's quite brilliant, really. Market engineering.
Okay, so they've accumulated low, marked it up, even built in future buyers via short traps. Now comes the end game, distribution, when the public finally gets excited.
Right. Public sees the rising price, hears the positive buzz, and piles in, convinced it's a sure thing. They're buying greedily. This is the signal for the professional manager to start selling in earnest, as Neill puts it.
Selling into that public buying frenzy.
Exactly. There's often huge volume, lots of churning, but the price might start to struggle to make new highs. And then comes the final act.
The big news hits the papers. The dividend, the great earnings, whatever it was.
That's the final, loudest advertisement. It brings in the last wave of eager public buyers, and the professional unloads everything they have left into that excitement.
And then
Silence.
the pro is gone. No more supporting bids. The public buyers are suddenly alone, holding stock that starts to slide. Panic sets in. They sell out, often near the bottom, locking in their losses.
They follow the classic losing strategy. Buy on tips, sell on dips.
Tragically, yes. And Neill's whole point is, you need to understand this entire cycle so you can try to ride with the professionals during the markup. And crucially, get out before or as they start distributing. Don't be the last customer.
Which brings us squarely to part 2. How do you actually see this happening on the tape? Okay, so if the pros are pulling the strings, the ticker tape is where you see the puppet move. Neill's second step, interpreting the tape. And he's very clear. It's not about seeing mystical signs or predicting the future. The tape is just a factual record.
A record of what?
Of human nature in action, expressed through financial transactions. It simply shows the results of the ongoing battle between buyers and sellers. Who's winning, who's losing right now.
And to read it properly, he starts with a kind of mental reset, a specific mindset shift.
Yeah, this is really interesting. He says, forget the word points. Stop thinking about price moves in points or ticks. Instead, think only in dollars.
Why? What's the magic in thinking in dollars if a stock moves up a point and moves up a point?
It forces you to grasp the magnitude of the money changing hands. Saying steel traded 5,000 shares is one thing, but calculating that at $170 a share, that's $850,000 worth of commitment. That's different.
Ah, I see. It connects the volume directly to the financial weight behind the move. A small trade and a huge trade might move the price the same amount, but the implication is totally different.
Exactly. It helps you gauge the real strength, the real urgency of the buying or selling pressure. Are we talking about pocket change, moving the price, or serious capital? That dollar mindset is key.
Okay, so thinking in dollars helps weigh the volume. This leads to his core principles for interpreting that volume, right? How to read the supply-demand balance. There are 3 main scenarios.
Yes, 3 fundamental patterns based on volume action. The first one is the healthy sign. Demand is clearly greater than supply, confirming an ongoing advance.
How does that look on the tape?
2 key things. First, you see increasing volume as the price rises. That's the fuel. Could be pros buying, could be the public joining in, could be shorts covering. Momentum is building.
Okay, rising volume on the rise. What's the second part?
This is the crucial confirmation. Any pauses, any little pullbacks or setbacks during that rise, they happen on light volume, very low activity.
Right. So why is that pullback on low volume so bullish?
Because it tells you nobody is rushing to sell. The supply has dried up. If the price dips a bit and the tape goes quiet, it means the professionals who are buying are just resting. They're not dumping. And importantly, the existing holders aren't panicking out. Selling pressure is absent.
That makes sense. It confirms the uptrend is solid.
That must be where that old saying comes from.
Never sell a dull market. Exactly. Especially a dull market during a correction within an uptrend. The dullness means the sellers are exhausted, accumulation might be happening quietly, and the path of least resistance is likely still up.
Okay, so that's the healthy sign. What's the danger signal, the turning point?
Right, the turning point on heavy volume. This is often the climax, top or bottom.
What does that look like?
You see huge churning volume, maybe 2, 3, 4 times the average daily volume happening right near the peak of a rally or the trough of a decline. But, and this is key, the price makes very little or no further progress.
So tons of activity, but the price is just spinning its wheels. Exactly. Think of it as a massive tug of war. At a top, the public is buying like crazy. But the professionals are now unloading huge amounts of stock, meeting all that demand with supply. All that effort, all that volume, results in stalemate.
That signals distribution is happening in a big way.
Absolutely. It's a massive transfer of shares from the strong hands, the pros who bought lower, to the weak hands, the public getting in late. Neill actually used an example from June 1930 a day with 6 million shares traded, which was enormous then. It marked the bottom of a nasty decline. All that fear-driven selling was absorbed by buyers. Massive volume with no further price drop signaled accumulation.
So heavy volume without price progress marks a turn. What's the third scenario? Is there another way a turn can happen?
Yes, the opposite in a way. The turning point on light volume. This usually happens at market tops.
So not a frenzy, but fatigue.
Exactly. The market struggles higher, maybe slowly, sluggishly, maybe on noticeably decreasing volume. Just seems to run out of steam and then it just dies at the top.
Meaning what? No buyers left.
Pretty much. There's a distinct lack of demand, lack of conviction. Buyers aren't willing to pay higher prices, and maybe sellers aren't aggressive yet either. It hasn't climaxed, it's just exhausted.
So what happens then?
Well, because there's no enthusiastic buying underneath, the market can just roll over under its own weight, or sometimes a sudden piece of bad news can cause a sharp break, because there's simply no bids there to absorb the selling. It's a top formed by apathy, not by a blow-off.
To apply these volume principles, Neill stressed watching the market leaders. Back then, it was all about U.S. Steel, right? Ticker symbol X.
Steel was the bellwether. Huge company, widely owned by institutions, always actively traded, but usually in small, steady increments. Not a wild, speculative stock.
So its action was seen as a reliable gauge of the real money, the institutional sentiment.
That was the idea. Neill basically said, watch Steel. If the flashy speculative stocks are soaring but Steel is lagging, or worse, breaking down on heavy volume, be careful. It might mean the pros are selling the broad market under the cover of strength in a few leaders.
Like watching the big index ETFs or the mega cap tech stocks today for divergences.
Exactly the same principle. Look for confirmation or non-confirmation from the key market generals.
Now, within a specific trade, how do you gauge the immediate urgency? You mentioned hitting the bid versus buying the asked.
Right, this is looking at the microstructure. The bid is the highest price someone is currently willing to pay. The ask, or offer, is the lowest price someone is willing to sell at.
Okay.
If a trade happens at the bid price, it means the seller couldn't wait. They took the buyer's price immediately. They hit the bid. That signals selling urgency.
And the opposite.
If a trade happens at the ask price, it means a buyer couldn't wait. They paid the seller's price. They lifted the offer or bought the ask. That signals buying urgency.
So by watching where the trades are executing relative to the bid-ask spread, you get a real-time feel for the immediate pressure.
Yes. Is the desperation on the buy side or the sell side right now? It's a very granular piece of information.
And this relates back to those professional maneuvers you mentioned, like a false move.
It can. A pro might, for example, dump a large block of stock deliberately below the current bid price. That looks scary, right? Might trigger stops.
Yeah, it looks like sudden weakness.
But if that's immediately followed by a series of smaller trades, where buyers are aggressively buying the asked, lifting the price back up, it suggests the big sell-off might have been strategic. Maybe to shake people out or clear out sellers before resuming the intended upward move.
So you can't just look at the price jiggle. You need the context of the volume and the bid-ask action.
You need the whole picture. Volume confirms the significance of the price move.
Neill gives a great case study on this Lowe's stock in November 1930. It was tanking, right? Down from 57 to below 53, even while the rest of the market was trying to rally.
Yeah, it looked terrible. Bad rumors flying around, poor earnings, maybe liquidation of a major holder's position, just waves of negativity.
But the tape told a different story on the day it bottomed.
Exactly. On November 14th, it hit that low, 52 and 34, and the volume exploded. Huge turnover, NXLN confirmed. It didn't stay down there. It rallied strongly off that low and closed more than $2.50 higher for the day.
That rebound, combined with the massive volume.
That was the signal. Neill flags it as a classic case of heavy volume without progress marking a turn. The price couldn't go lower despite the panic and the volume. It meant strong hands were eagerly absorbing all the shares the panicked sellers could throw at them. Accumulation.
The sellers were exhausted and the buyers stepped in forcefully.
Yes, and the confirmation came in the following days. When the price pulled back slightly, the volume just dried right up. No more supply. That validated the low.
This interplay between news and tape action leads to another classic rule Neill liked.
The old sell on good news rule. He thought it was generally sound advice.
Why? Seems counterintuitive. Good news should make the stock go up.
Because, as we discussed with the pool operations, the really important market-moving news is often the culmination of the professional campaign. The insiders knew about it weeks or months ago. They bought cheap, marked it up, And the news hitting the public is the final advertisement to unload their remaining stock onto the excited crowd. The price has already discounted the news.
So by the time it's in the newspaper, the smart money is often heading for the exits.
That's the professional viewpoint, yes.
Okay, one last thing on tape reading. Support and resistance levels. Those old highs or lows where prices often stall, are they just magic lines on a chart?
Neill says definitely not. They aren't mechanical barriers. Think of them as areas where the balance of power between buyers and sellers previously shifted. They are temporary equilibrium points.
So the key isn't the level itself, but what happens when the price gets there.
Precisely. You have to watch the volume as price approaches a known support or resistance level. Does volume dry up as it nears support? That suggests sellers are losing interest. The support might hold.
And if volume picks up as it hits support,
if you see large transactions continuing to push down through the support level, it suggests the buyers who are trying to hold that line are being overwhelmed or have pulled their bids. The support is likely to break. Again, volume tells the story of conviction. Price is just the score.
fascinating. It's all about reading the force behind the moves. Which brings us to the hardest part, managing our own reactions to it all. Part 3. All right, we've talked about understanding the pros and reading their actions on the type. Now, Neill's third step, the one he calls the toughest, mastering yourself.
Yeah, this is where it gets deeply psychological. He argues pretty convincingly that even if you become a perfect tape reader, you can still fail miserably if your own mind works against you.
Because of emotions, pride, vanity.
All of the above. Greed making you overstay your welcome, fear making you sell too soon or miss opportunities, pride making you stick to a losing position because you can't admit you were wrong. These are the capital killers, he says.
It's the internal battle. And he uses a clever device to illustrate this, right? The market cynic.
He does. It's like his sarcastic alter ego who writes this list called 10 Ways to Lose Money in Wall Street. It's brilliant because it tells you exactly what not to do by framing it as advice to lose money.
Reverse psychology for traders. Let's hear a couple of those losing tips.
Okay, well, number 1 from the cynic is, put your trust in boardroom gossip. Number 2, believe everything you hear, especially tips.
Ugh, yeah, that sounds like a recipe for disaster.
Neill's point is, if a tip was truly that good, why would anyone share it? They'd mortgage their house and keep it quiet. Number 4 is another classic. Follow the public.
If everyone's doing it, you're probably too late.
Or about to be caught in a reversal. But the 2 points that really nail the psychological flaws are, number 6,
Which is?
greedily hang on for the top eighth.
Oh, man. That one hurts because it's so true, trying to squeeze out that last tiny bit of profit.
And watching a huge gain evaporate because you got greedy, right? Then there's number 8, hold to your own opinion, right or wrong.
Stubbornness, pride, refusing to admit a mistake.
Exactly. Neill identifies greed and pride as the primary destroyers. That desire for the absolute top tick and the inability to cut a loss because your ego's tied up in being right, that's what blows up accounts.
So how do we fight these impulses? Neill suggests adopting a different mindset entirely.
Yes, he says, think like a merchant. An impersonal, business-like perspective.
Remind us how that works. Stock is merchandise.
Its saleability depends on demand, which he calls fickle style. Fashions change, demand changes.
So if you, the merchant, bought a bunch of coats and suddenly nobody wants that style anymore.
You don't hang on to them hoping the fashion comes back next year. You cut the price. You have a sale. You take the loss, get rid of the bad merchandise, and free up your capital to buy something that is in demand.
Take the loss quickly and move on. Well bought is half sold.
That's the discipline. If your initial purchase was based on sound tape reading, confirming demand, you're already halfway there.
Yeah.
If you bought poorly or the situation changed, admit it fast, liquidate, preserve capital.
This thinking leads directly to his warning about one of the biggest traps for that prideful part of us. Averaging down.
Oh, the averaging trap. It feels so tempting, doesn't it? Buying more of a stock that's gone down to lower your average cost basis.
Makes it look better on paper, maybe helps you break even sooner if it recovers.
But Neill argues it's incredibly dangerous, precisely because it satisfies that pride of opinion. You're essentially saying, my first decision was right, the market is wrong, so I'll double down.
You're reinforcing a mistake.
You're buying more of something that has already proven to be worth less than you initially thought. If the underlying trend is truly against you, averaging down just makes your eventual loss proportionally larger. It's throwing good money after bad, driven by ego.
So what's the Neill alternative? If you shouldn't average down.
He suggests the opposite. Consider averaging up.
Buying more only after the stock has already moved in your favor.
Yes. If the stock advances after your initial purchase, it confirms your judgment was correct. The trend is with you. Adding to a winning position while managing risk makes logical sense. You're reinforcing success, not failure.
Buying based on confirmed momentum, not hope against a downtrend.
Okay. Now, Neill constantly emphasizes that the public is usually wrong, especially at major turning points.
Yes, the crowd gets most emotional, most certain right at the extremes, maximum bullishness at the top, maximum pessimism at the bottom.
So the goal for the disciplined speculator isn't necessarily to be a lone wolf contrarian all the time, but to time things differently.
It's about timing your commitment. You want to identify when the insiders, the professionals are accumulating, try to tag along with them for the main part of the move, and then this is critical, get out before the public rushes in at the end, or as the pros start selling to that public.
Precede the public, both buying and selling. That's the aim. Tape reading helps you spot those psychological turning points. He mentioned that November 1930 example again, after 51 days of decline, suddenly everyone wanted to sell short. That extreme public pessimism was the signal for the pros and for Neill to buy. You have to be willing to act contrary to that emotional consensus.
Easier said than done. So to help build this discipline, Neill offers some very practical, almost like training exercises.
He does. Very specific suggestions. First one, trade alone.
Meaning, lock yourself in a room.
Metaphorically, yes. Close your mind to the constant chatter, the news, the tips, the opinions of friends, the noise on financial TV. If you're basing your trades on your own tape reading and judgment, then trust that. Don't let outside opinions sway you or introduce confirmation bias. Stand or fall by your own analysis.
Makes sense. Too much noise clouds judgment. What's next?
Second, something that sounds old school, but the principle holds. Use pad and pencil.
Literally write things down.
His exercise was to pick a key stock, like steel, and for an hour straight, write down every single transaction price and volume.
Wow. That requires intense focus.
That's the point. It forces deep concentration, trains your observation powers. He believed doing this regularly helps you develop an intuitive feel for the tape's rhythm, the ebb and flow of buying and selling pressure, beyond just consciously analyzing it. It's practice.
Okay, trade alone, practice observation. What about time frame?
Third, trade the intermediate trends. Avoid the noise of tiny fluctuations.
So don't try to day trade for pennies.
He strongly advised against it for most people. Scalping requires incredible speed and execution, and the minor wiggles are often just random noise or manipulative feints. Focus on the bigger swings, the moves that last, say, 3 weeks to maybe 6 months.
Because the main profitable part of a move is usually in the middle section?
Generally, yes. The initial bottoming and final topping phases are often choppy, dangerous, and hard to time perfectly. Capturing the solid middle portion of a trend is where the more reliable profits are, with less risk of getting whipsawed.
Okay, focus on the intermediate term. And then there's his most, let's say, financially hardcore rule.
Ah, yes. The margin call rule. Brace yourself for this one.
I'm ready.
Never answer a margin call.
Never. Just let them sell you out, even if you think the stock might come back. That sounds brutal.
It is brutal, but his logic is cold, hard, and unemotional. Why do you get a margin call?
Because the stock has dropped significantly and your equity in the account is below the required minimum.
Exactly. The market has delivered a verdict. Your initial judgment was significantly wrong. The position is losing badly.
So answering the call, putting more money in?
Is throwing good money after bad. It's letting pride or hope override the market's clear signal. You're doubling down on a mistake just to avoid admitting it or taking the loss.
Neill basically sees the margin clerk as your disciplined friend, forcing you out of a bad situation before it gets worse.
That's the idea. It's the ultimate expression of disciplined loss cutting. If you hit the margin call threshold, the trade is fundamentally broken according to your initial risk parameters. Liquidate, preserve capital, move on. It takes immense discipline, but he saw it as essential.
Wow. That's a powerful, if painful, set of principles. Hashtag tag outro. So wrapping this up, we've journeyed back to 1931 with Humphrey Neill, and it feels remarkably current, doesn't it?
It really does. His 3 steps still form the core of successful speculation, I think. First, understanding the game, who the major players are, their motives, their tactics, whether it's 1930s pools or today's giant funds.
Right, recognizing that accumulation and distribution cycle is still happening. Second, learning the language, reading the tape, focusing on volume is the key indicator of supply and demand.
Thinking in dollars, watching for those key volume signals. Confirmation on light reactions, warnings on heavy churning without progress, that hasn't changed.
And third, the hardest part, mastering yourself, battling that internal greed, fear, and pride, adopting that merchant's mentality.
Cutting losses quickly, avoiding the averaging trap, maybe even having the guts to follow that margin call rule. That internal discipline is paramount.
Neill was adamant, wasn't he? Speculation isn't a science you can just solve with a formula.
No, he called it an art. That's why purely mechanical systems often fail eventually. Because human psychology, human emotion, isn't constant or perfectly predictable. You have to constantly interpret the supply and demand reflected on the tape. It requires judgment, flexibility.
So we've seen the playbook, the tactics, the psychological pitfalls. The biggest dangers, it seems, really are internal. Pride, fear, greed.
They lurk within all of us when money is on the line.
Which leads us to the final thought for you, the listener. If Neill is right and self-mastery is the key, you have to ask yourself, what's your biggest psychological hurdle? Are you prone to hanging on for that top eighth, like the market cynic warned? Do you fall into the averaging crap out of pride?
And maybe more importantly, what's one concrete tactical rule? Maybe it's Neill's margin call rule. Maybe it's something simpler like always using stop losses. What rule will you commit to right now to combat that specific weakness?
Because that level of self-awareness and discipline, that's the real deep dive into potentially finding lasting market success.
Study the tape, but more importantly, study yourself.
We'll see you on the next deep dive.